thank you everyone for coming to the webinar today. Good morning, afternoon, wherever you might be. And again, thank you for joining us for part 2 of our webinar series with Modeloptic. We're excited to dive deeper into strategic financial planning and practical applications of the FP&A tool. For those who were with us last week, welcome back. And if this is your first time joining us, we're happy to have you here as we explore the best practices for managing businesses using rolling forecasts, variance analysis, and dashboards. So it's my pleasure to hand things over to our presenters today. Eric DeMar is our CEO of DeMar Consulting Group, and Trevor Mullen, co-founder of Modeloptic, and they're going to be leading us through today's session. So, gentlemen, go ahead and take it away. I'll be back with you at the end.
Thanks, Matthew. Yeah, so in the first webinar, we covered the foundations of what a financial model is made up of. The next step is learning how to leverage it for ongoing optimization. So regularly updating and refining the model ensures it stays aligned with your business's ongoing strategy and reflects real-time data. We'll talk about the importance of regularly updating your model with new actuals from your accounting system, setting up rolling forecasts and reforecasting. Then we'll dive into variance and scenario analysis, both tools to help you stay on top of the performance and plan for uncertainty. And finally, we'll discuss the importance of dashboards and report decks that make your financial insights clear and actionable for stakeholders, followed by some Q&A. So by the end of this session, you'll have a better roadmap for integrating your financial model into your business management in a way that drives growth and efficiency. So really throughout this presentation, I'm going to walk you through the best practices, Trevor and I, for not just what these concepts are and how Modeloptic handles them, but you'll learn how and why the tool Modeloptic is superior to legacy Excel-based processes. At the end of the day, Modeloptic is a purpose-built modeling tool where Excel is not. Next slide, please. So before we dive into today's topic, I want to give you a little background on DeMar Consulting Group. We offer full-service finance department solutions that go beyond traditional CPA services. Many small to medium-sized businesses work with CPA firms that primarily focus only on compliance and filing tax returns. We fill the missing gaps by providing a comprehensive financial team, offering both a high-performing tax team and a dedicated finance operations function like accounting, data analytics, strategic finance, payroll, accounts payable, accounts receivable, and more. We call this our Office of Finance as a Service. Next slide, please. Rolling forecasts. Okay, these are essential for businesses that want to remain flexible. So rather than relying only on an annual budget that's completed once a year, a rolling forecast allows you to continuously update your financial outlook over an ongoing 12-month period. We recommend updating this forecast every single month. It's about having a living model, a living document that adapts with you so that you're not locked into assumptions that were made in your annual budget cycle that are probably no longer relevant, which is often the case almost immediately after you finish that annual budget. So to maintain an accurate and up-to-date financial outlook, it's essential to update your rolling 12-month forecast model as soon as the previous month's actuals become available to refine your assumptions, adjust scenarios in real time, and ensure that your forward-looking projections remain relevant. So now I'm going to pass it along to Trevor to demonstrate how Modeloptic automates a lot of this process.
Awesome. Thanks, Eric. So to take a deeper look at Modeloptic and how our process transcends Excel, I'll first by quickly reminding us what the Excel process entails. So as we all know, we'll go to our accounting system, we'll download our 3 statements, we will paste those accounting detail files into our Excel-based model, and step forward tab by tab, touching hundreds of cells, updating formulas and references to update the model. And ultimately, that process takes about 2 to 3 hours worth of manual work, and it's introduced human error into the equation. Comparing that to Modeloptic, our process is extremely efficient through the accounting integrations and automations that we have. It takes minutes versus hours, and it removes that human error that I described from the equation. But since the process is so efficient, we can actually go through it right now really quickly on screen. So first, I'm going to go to our historical data page in our model. And because it's October 7th and we've only got August actuals in the system right now, I would assume the September books are closed. So I'll come here first. I'll set this option to September, and I'll save that, telling the system we want to pull through September. Next, I'll click the refresh button. This account or this model is connected to QuickBooks, and you'll see that in just a few, we will try that one more time. I did do just this just earlier. Here we go. It must have just hit a cycle on the back end. But as you can see, it's working through, pulling all the data from the 3 statements: transactional detail, AR, AP, that sort of thing. So it refreshed, and that took only seconds. And now the system's holding our actuals through September, and it's ready to push it into the model. Now, one other thing I wanted to quickly describe is, with a growing company evolving over time, it's often that you would have new accounts, maybe with new activities, new offerings, that sort of thing. If that ever happens, this is what it would look like. There'll be a new account with no relationship created, but it's very easy to create a relationship and then move on forward. So the last step here is to push these actuals into the model. I'll hit Save Mapping Options and Generate. And as you can see, we get a notification that says the income statement ties, the balance sheet ties, and cash matches. So all of this gives you the assurance that we tie to the penny to your accounting system, which is the source of truth on the historical side. So now we'll go to the financial detail page, which is the main model. And as you can see, the September column is populated with actuals, which is great. But the last step of this roll forward process is, as you can see, we've only got an 8-4. This nomenclature means August actuals and then 4 months of projection, September forward. We need a new unlocked version that we can create our rolling forecast and toggle assumptions in. So that last step is done by coming to this projection sets page. We always would recommend that you keep a locked historical version of your projection set, whether that's for backup purposes or comparison purposes when we get to the variance. But I'll simply just clone this 8-4. So I have another version of this, just set a few parameters here. I would call this, again, our convention, 9 being September actuals through October forward in the rest of the year. And I'll just set a few last parameters, unlocking this and saving that. So at this point, we have that static version, but I also can come out to financial detail, and we have a live dynamic version that I can toggle assumptions in, making different projections into the future. Now that we have our actuals in the model, and we want to flow through and actually tweak the assumptions, stress testing some of the different assumptions that we have, some of the inputs, ensuring that with any new information that we have our best picture going into the future. And so one other huge thing that I did want to mention, the benefit that we get from our accounting integration, it's not just that efficiency that you just saw, how quickly we could bring in the new actuals, but it's transaction level detail at our fingertips, which we touched on in our last call. So taking a look at that, if you're going through a reforecast cycle, it's so awesome to be able to just click in, understand what makes up the activity of a given account. And maybe then that gives you a better sense of what's going to persist into the future. So for instance, if we know that our wave contract is coming to an end and we're no longer going to engage with them, that could jog my memory in the model itself that I should come here and change the assumptions into the future. So there's a lot that we can discuss on rolling forecasts, but I'll pause there. As you can see, our Modeloptic process, it's significantly more efficient and accurate than the Excel-based workflows, in addition to the insights that we put at your fingertips. But we'll pause there, and I will pass it back to you, Eric, for our next topic.
Thanks, Trevor. Yeah, I mean, it, really doesn't matter what your accounting system is, QuickBooks, Sage, NetSuite, so on and so forth. The actuals are automatically integrated. So moving on to variance analysis. So once the model is updated with the latest actuals from the previous month after the books have been closed, the next step in the strategic finance process is to dive into variance analysis. This process is for identifying the differences between your annual plan, your budget, or your forecast, and the actual performance that happened in the business to give you a more clear view of where your business might be off track. It's it's about understanding why these variances occurred, right? So were your assumptions about sales volumes too optimistic? Did unexpected expenses creep in? So by really analyzing these gaps, you can get to the root causes of the variances, and document what those are right inside the tool, which allow you to further refine your rolling 12-month forecast for the future. So uh, through variance analysis, you're uncovering operational efficiencies or emerging risks that may not have been obvious in your annual budget. So for example, more examples really is if your costs consistently exceed forecasts in certain departments, it could indicate inefficiencies in resource allocation. Another example is if revenue is underperforming compared to your projections, it may signal shifts in customer behavior or market conditions that need immediate attention. And we can reflect these changes in the business by tweaking the drivers of revenue that are built into the model. We talked about this in the last webinar. Things like conversion rates, lead flow, cost per acquisition. These are drivers that affect your business, and we can tweak those drivers. So now I will pass it back to you, Trevor, to demonstrate why Modeloptic is the best tool for variance analysis.
Great. So picking up where we left off, we brought in the new actuals. The natural next step is after the roll forward to compare those new actuals against perhaps a historical projection set. And our variance page does exactly that. So I will navigate here. And as a quick aside, my background, I worked in corporate finance FP&A predating Modeloptic. This is one of my favorite pages. I was working for publicly traded companies, billions of dollars annually in revenue, and we always wanted a dynamic variance analysis page such as this, but we never could get there, where you're seeing it on screen right here, right now, and we'll take a closer look. But as I see it, there's really kind of three main workflows to highlight here. The first one's probably a little less obvious to most of you, but I tend to appreciate this perspective. And so that's, the controller function. And so I believe there's a lot of value to, before you really get into the weeds and really start to try to dig into variances and tell the story, I like to first do a quick preliminary review of the accounting data to make sure that everything's bucketed in the right places and that sort of thing. And so, of course, you could do that in your accounting system, but the reason that this provides some additional benefits is that we have the context of our projection. So, maybe you're seeing that there's a misalignment between where you bucketed the actuals and where you forecasted those same amounts. So you can correct that. Or maybe, there was a big invoice that you expected to hit. It didn't hit, but this jogs your memory that you should, book a journal entry and accrue for that amount. So, we still are the outsourced CFO for a lot of our customers, in addition to our software product. And whenever we walk through this process on a monthly basis, we often make changes to the accounting detail. And the benefit there too is you saw that process, you saw us pulling the new actuals. It takes seconds. So if you were to go to your accounting system, make changes, you could quickly come back here, repull the accounting detail, and then get to the variance to start taking the next workflows and proceeding on forward from there. So that next kind of workflow, I mentioned there's kind of three. The next one is the standard FP&A process we all know and love. That's going to be digging into the variances, favorability, unfavorability, that sort of thing, thus understanding and analyzing the performance. And again, there's a huge benefit by this transactional detail that we just saw, You don't need to jump between systems to understand what makes up this activity, why you're up, why you're down. You can click in and see what makes up the activity, getting comfort with the variances that you're seeing. And then with these learnings, there's a couple takeaways, and Eric was hitting on a few of those, but, based on your review, maybe you want to go back to your rolling forecast, tweak the projections, tweak assumptions, that sort of thing, because this has indicated that there might be something that's misaligned with the future. Additionally, maybe even more impactful, this could escalate, any potential risks or opportunities also, as Eric mentioned. So, if you uncover, a risk or an opportunity, you can be proactive about the decisions you make and better manage your business as such into the future. So we covered the accounting kind of controller hat. We covered the FP&A, data analysis and analyzing performance hat. The last one is going to be the CFO hat. And so this one's, telling the story, communicating your performance ultimately to internal and external stakeholders. And so as you can see, we can input commentary into the variance analysis. And this commentary is also stored. So anytime that you've put in any comments in any prior months or projection sets, you'll be able to always see this. And this is great. Maybe it's later in the year, you're trying to remember why you were up or down or what that wonkiness was at the beginning of the year. You can come here, it's all aggregated for you, and you can understand what that was and remind yourself. But quickly to just look at a few other features here. This is 3 statements. So we've got our income statement, our balance sheet, our statement of cash flows and key metrics. Additionally, there's a lot of opportunity to customize what you're looking at. So one of those ways would be maybe the different time horizons. So I could look at, instead of just September, the current month versus a budget, I could look at year-to-date September versus year-to-date budget. Additionally, what you're comparing against. So maybe you want to compare against historicals. So, a prior month comparison or a prior year comparison. And lastly, this one's a favorite always, both looking at the forecast and the budget, because yes, the reforecast, so this mid-year reforecast, it's got the most current assumptions, the most current view of the world. And so maybe that's better to tightly manage the business and make sure everything's on track, but you still don't want to lose sight of your budget, which are your longer term goals and hopefully what you're still guiding towards. So as you can see, Modeloptic redefines the variance process by automating these time consuming manual tasks that typically bog down our financial teams. But by streamlining these workflows, it empowers your team to focus on what truly matters. And that's going to be making informed decisions and steering your business towards its strategic goals. With that, Eric, I will flip it back to you for our next topic.
Thanks. All right. So when creating forecasts and different models, the use of scenarios inside of Modeloptic is a really valuable tool for preparing your business for the uncertainty that is inevitably gonna happen. So scenario planning allows you to model out different possibilities, such as a best case scenario for the next 12 months, a base case scenario, and a worst case scenario. These are just 3 examples I'm giving. But by adjusting the drivers of your model, key assumptions, these scenarios really allow you to see how these various factors might impact your ultimate financial performance, your comprehensive financial picture. This gives you the ability to proactively prepare, once again, for both opportunities and risks. So with that, I'll pass it right back to you, Trevor, to show the scenario analysis capability inside of Modeloptic.
Perfect. So, as we've discussed in the last 2 workflows, it's clear that the process is of continuously reviewing projections and dialing in assumptions is ongoing. And taking that a step further, as Eric mentioned, a great way that takes shape is through scenarios. Ultimately, you'll craft different versions of the future, assessing their potential outcomes. And so looking at that from more of a technical perspective, how you could approach that, I'll come back to the financial detail page. And the first approach, there's really 2 approaches. The first is using the if function that we all know from Excel. We have a similar function in Modeloptic. And here's an example of that. So where this works best is maybe you only have a few assumptions that you want to toggle, and you want to be able to toggle those assumptions with the click of a button. And so in this case, this is a SaaS demo co. we've got a number of new subscribers into the future. And so I've set these three different scenarios at the top, preset these with a high, a base, and a low set of new subscribers that I expect to come on every month into the future. And so here, based on this input, it's currently a 3, so it's pulling 50, which is our high assumption, down into our revenue build, allowing us to calculate our revenues. If I were to toggle this to a 1, it's now going to pull the assumption from our low case, the 10. So this is great, again, if there's just a few assumptions and you want to be able to toggle through and see their impacts. That said, there's another approach, and that one is kind of a more broad approach that involves creating a new projection set from your existing active projection set. As you can see here, we've got our 9-3 forecast. So this would be, as Eric mentioned, kind of your base. But I've created a downside and an upside, more conservative assumptions, more aggressive assumptions. And where this works best is when you want to make a lot of input assumption changes all throughout the model. Maybe you're tweaking the revenue, and that's going to affect your COGS and also your personnel or your OPEX. And maybe there's even balance sheet implications. So in this case, the if doesn't work great because you really just need to flow through the entire model and tell a different story. And so, taking this projection set approach just a step further, I can give you a real world example that we came across earlier this week. A customer of ours, they found themselves in a bit of a challenging environment. As we know, all small businesses, small to medium-sized businesses, this is very common. And as such, they're very focused on their cash projections through the end of the year. With that goal in mind, we created 2 new projection sets, the first being a downside. And so all that will persist is their existing backlog, the stuff they have in hand, no new incremental sales through the remainder of the year. So that's the worst case scenario at the revenue line. And then we've made other OPEX and balance sheet adjustments as well. And then the second, we called it more of a realistic downside, but that's going to have that same in-hand backlog, but it also has a very low incremental amount of new sales, which it's a low bar. And the leadership thinks that if that's ultimately what they achieve, they might need to get rid of that sales team because they're not doing what they've been brought on to do. So a very low bar to achieve. But ultimately, these 2 scenarios that we've created, they're going to give a great sense of what cash could look like in the future, ultimately allowing that CEO to contingency plan and get ahead of any potential rough waters that they may see later this year. So as you can see, the work isn't complete when you finish building a model. You need to continuously revisit and stress test assumptions with the most current information that you have, getting ahead of, again, any potential risks, or, there's also the upside, taking advantage of potential opportunities. In this way, Modeloptic is a game changer compared to Excel on an ongoing basis. As we all know, Excel files degrade over time, becoming less reliable as they're shared with the team or modified, where Modeloptic, on the other hand, this is going to provide built-in safeguards to keep the model accurate and error-free, eliminating the need to second-guess any of its reliability. So with that, Eric, back to you for our last topic.
Yeah, thanks, Trevor. So, we've done the annual plan, we've tweaked the forecast, we've done variance analysis, we've done scenario analysis. And so next we move on to dashboards and reports, which are powerful tools for making all of this data both accessible and actionable to leadership. A well-designed dashboard gives stakeholders a quick snapshot of the business's performance, of all the work that we just talked about, where it highlights key metrics and trends. And the beauty of these dashboards and reports is that they can be customized to fit the needs of different audiences in the business. So the different audiences in the business could be the executive team versus a board versus department heads versus investors. So at DeMar Consulting Group, we use dashboards and reports for our clients inside of Modeloptic to simplify complex financial data, keep our clients focused on their goals. We often build decks for monthly meetings for them where we focus on providing these high-level insights, key takeaways, and the most relevant data, with simple charts, clear comparisons, focused messaging. This is what turns data into management decisions. So Trevor, can you please show us the use of dashboards and reports inside of Modeloptic?
Yes. All right. So, just to recap, now that we have a robust model, we've brought in new actuals, we've created a rolling forecast, analyzed the performance, and stress tested our assumptions. Again, the last piece, as Eric mentioned, is the last piece of the puzzle is to bring all that information together, presenting it in a summarized, digestible fashion. And thus, that is our dashboard and our reports page. And so going there, I'll start with the dashboard side of things. We can first look here. And as you can see, we have a whole host of different graphs, tables, charts, intended to be visual representations of your financial data that can be reviewed at a glance. And your Modeloptic instance, when you start with us, it'll start with these 6 dashboard reports that cover kind of all the key areas you would expect to see. So income statement, balance sheet, cash flow, as you can see, some cash flow reports here, variance analysis, we've got key metrics, and ultimately core financials, which covers kind of a sampling of all of those. So you'll get this kind of off the shelf once you sign up for Modeloptic, but from here, you can customize it further as you see fit. This is super flexible, whether you want to create new reports, delete reports, create new reports from presets, or whether you want to edit the existing report. So this is all super flexible. I can change any of these objects, shuffle them around as I see fit, or what's actually flowing through them. I can change the type of visual that it is, or what the data that's flowing through it is, and even the time horizon that we're showing. So in this case, we've got a current month in the middle, 6 months trailing, 6 months forward. That'll just step forward every month we bring in new actuals, but maybe you would prefer to see more of the calendar year, the current calendar year in more absolute terms. So as I just set this from January through December of 24, you could just see the calendar year in your given visualization. So, and one of the last things to say about dashboard, the best part about all of this, which you've kind of already seen through some of the other workflows, is that this automatically updates. So once you bring in new actuals or you make adjustments to your forecast, it'll update, and you're going to gain the efficiencies and the accuracy of Modeloptic, transcending any of the Excel-based processes that we're used to. Taking this one step further, we can look at reports. So I'll navigate there. Reports is very similar to dashboard, but where the dashboard is intended to be used more on screen with kind of a limitless canvas that you can continuously scroll down on. Reports is intended to be more like a formal deck with pages that have kind of fixed heights and widths, and that you can ultimately PDF and share that way, or you could turn on a presentation view to walk through on screen, much like a PowerPoint as well. So taking a look at that, I will jump in. You can see we've got 6 different reports here, but I'll start with the core financial report. And as you can see, it's got additional features like a cover page, that sort of thing. Table of contents you could create as well if you wanted to, or section headers, that sort of thing. But you can also see all of our previews of the different visuals that are in these reports. But then, as I mentioned, the different ways you can share this is one is going to be PDFing it. And so that will look like this, where you've got all your different pages. It's almost like a PowerPoint, as I mentioned. So this is a great way to share it if that's what your stakeholders prefer to see. Or the other option is you can use the presentation view, and again, use this much like you would any sort of PowerPoint presentation, and flip through it on screen live through the interface. But again, much like I've described with the dashboard, off the shelf, you've got a lot of reports that you can leverage, preset reports that you can leverage, or you can customize your reports to your own specific needs. And, it's ultimately super flexible. The possibilities are endless. And yeah, we're excited to get you guys in here, hopefully sooner rather than later. But with that, Eric, I'll pass it back to you, and you can take us through kind of the end of this webinar.
Sounds good, thanks. So now that you all have a clear understanding, a better understanding at least, of how to take your financial model and projections through strategic finance processes, I hope you're realizing that the budget is no longer just a document sitting idle. It should be turned into a dynamic modeling tool that drives real ongoing value and helps guide informed business decisions. Each business now has unique requirements when building a model and a strategic finance process. So if you're ready to take your planning efforts to the next level for your business, I really do encourage you to schedule a call with us, because we've only scratched the surface of what Modeloptic can really do to transform your business. There is a link available for you to book a demo, and we'd love to show you how Modeloptic can fit for you. So with that, I will pass it back to you, Matthew, for the Q&A portion of this webinar. So please feel free to, you should have a feature to ask us some questions if you'd like.
Yes, thank you. Thank you both. Really, really great information there, and really great explanations and everything. So thank you for going through that. I did, there was a couple questions that I had going in. First question for you, Eric. How does tax planning work with DCG?
Yeah, great question. So at DCG, our tax planning approach is quite structured and client focused. During the onboarding of a new client, we discuss how frequently they'd like to engage in tax planning. While we generally recommend quarterly sessions for most clients, we sometimes do suggest a monthly cadence for more proactive tax planning. For example, our tax team coordinates with our accounting team to review monthly financials and ensure that your tax strategy is always aligned with your business's performance throughout the year. Additionally, I'd like to highlight that we do offer, we're coming up to the end of the year, Q4 here, so we do offer comprehensive year-end tax planning services specifically. I suggest you take us up on that sooner rather than later. You don't wait until the deadlines are here next year, because this is where we take a deep dive into your entire fiscal year, ensuring that no opportunities are missed and that your business is in the best possible position before closing out the year. It's a service that brings a lot of value, especially as we prepare for the upcoming tax season.
Awesome. Thank you. Thank you for that. I did want to say real quick, if anybody out there does have questions, I believe you can throw them in the chat. You can go ahead and think you can click the Q&A. You might be able to put them in there, and we'll read them as we go. So if anybody has questions, go ahead and throw them in the chat. For you, Trevor, I wanted to ask, do you support forecasting by department, or putting up by consolidation into multiple companies? Does Modeloptic support that?
Yep. Yeah, no, good question. And, we've went through in both of these webinars, front to back, the whole process of building a model through kind of your reporting decks, that sort of thing. But where this really starts to get interesting too is once you have multiple entities. So, we can be a huge help if you have those complexities. And to be honest, we have a significant portion of our customer base that use our multi-entity capabilities and see a ton of value from it. And so, speaking to the kind of two different approaches that we'll see, one of the ways that we call this multi-entity structure, it's more if you had departments. So maybe you want to forecast G&A, sales and marketing, R&D, see their own individual P&Ls. And so that's one way that we'll do that. And in that case, we have a parent-child structure in the hierarchy, the consolidation being at the parent, and then the child's having those departments, the child level being the departments. In that case, you would really just do income statement only for each department. There's really no need to have balance sheets by department oftentimes. But then as the income statement consolidated at the parent level, that's where you would then forecast and project your balance sheet and cash flow, just a single balance sheet and cash flow at that top consolidated level. So that's one approach that we see oftentimes. The other is when you have multiple corporate entities. So in that case, it's more often that you'll be forecasting full three-statement models at the lower level, that child level. You can have as many as you need, and those will consolidate up. So the parent level in that case really is just a simple consolidation of the income statements, balance sheet, and cash flow from the sum of its parts. I've been describing it in a kind of simple terms where there's just a 2-tiered hierarchy, but we actually support a 3-tiered hierarchy. And we have some customers that have 40, 50 plus entities that all roll up throughout their hierarchy. So tons of options there, and it's really super powerful. But taking that one step further, speaking about kind of the accounting side of things and how that works, just kind of dovetailing on what I mentioned about those two approaches. As far as the accounting systems, if you are doing departments, we could plug into, let's say, your NetSuite instance, and it would just be one connection to your NetSuite, but then we could reference your classes or your departments or locations, whatever the dimension is that you're leveraging. We could use that to then pipe the respective department level financials to their respective places. Whereas when I was describing the corporate entity side of things, you could have disparate accounting systems. I mean, they don't even need to be the same. You could have a QuickBooks instance for one entity, NetSuite for another, Sage for another, totally possible. And we'll connect to all of those independently and then consolidate up. One additional feature to mention about this or piece to the puzzle is the different permissions that you then can scope, because so often you could imagine, maybe you want to grant access to one employee for one of the entities, but not another, or maybe you give them edit capabilities for one entity, but read only for another. So there's tons of flexibility in how you grant permissions to in those multi-entity structures as well. So suffice it to say, if you manage these complexities manually in an Excel-based world, Modeloptic will be a game changer, not just on the accounting side, doing your consolidations, especially imagine that you needed to refresh the accounting. You don't need to, for a second time after making some tweaks, after that soft close, you can click a button with Modeloptic and in seconds, your entire hierarchy is refreshed versus having to start back from scratch in an Excel-based world, pasting in all the new information and working through the models. So a game changer, not just on the actual side, but then the projection side, having that all integrated in one system. Every feature that we went through on this call and the last call, those are afforded to you at each of the different levels as well in each independent entity. So just a ton of power, really a game changer if you have multi-entities. And I would definitely encourage you to reach out if that's something you're currently dealing with on a manual basis in Excel currently.
Awesome. Yeah, thank you for that. Really good answer there. We did have a question in the chat. Looks like we're asking, how does Modeloptic deal with new data structures in the process of importing data?
Yeah, I can speak to how we feed data into the system a couple different ways. So let me get back to Modeloptic. As far as the accounting side of things, I don't think we really hit this heavily in the last call, but you can see we've got 4 different accounting integrations: QuickBooks Zero, NetSuite, and Sage Intacct. But if you're not on one of those systems, you can also feed in data manually through Excel, which is still a really efficient, streamlined process. You basically get almost all the same benefits and functionality or features that you would if you had an integration. So that's bringing in the historical side of things. These are the only ways that you can feed the historical side of data. But as we all know, when you create a model, the accounting is, let's, for argument's sake, call it 80% of the historical information. But surely you're going to have other data inputs, other variables or metrics that are relevant either as backfilling drivers or potentially just KPIs that you want in the system as well. And so that process for feeding in data, you can see here through our key metrics page. You can either key in the information if the variables are available to you, either through the statements or any of the calculations you've already created. You can just calculate your metrics, or the other option is that you can download a template and you can feed in this information through, through this template. Our customers create automated processes on a monthly basis to be able to really efficiently grab all the different data from their disparate sources. If we had a new October column, populating this new October column and then feeding it back into the system. So those are a couple of the different ways that we can feed in data. There's a few others, on the personnel page, you can load in a template of your roster. On the customers module, you can backfill some detailed customer information if that's how you're forecasting revenue. But that covers kind of all the different ways that you can import data or feed in data into the system. So hopefully that answered your question.
Thank you. We do have a couple more minutes. Does anybody have anything? Awesome. Does anybody else have any questions? You can drop in the chat. I think we might be good.
Perfect.
So yeah, that brings us to the end of today's webinar. Hope you found it valuable. You gained some practical insight into how to apply it to your own financial planning and management. Definitely take advantage of that call. I put the link in the chat to schedule a call with DCG and Modeloptic. Just wanted to say a big thank you to Eric and Trevor for sharing their expertise with us today. And thank you to everybody who has taken the time to join us today. I know it was a little bit longer than last time, but I think we got a lot out of a lot of really good information from Eric and Trevor today. If anybody has any follow-up questions or they want more information, please don't hesitate to reach out. I can, I believe my email was attached here, but I'll drop my email in the chat as well. You can send that there. And again, on the page right here, you see in front of you, modeloptic.com/learn more. Schedule a call with us. Let's talk more and help integrate Modeloptic into your process. So we appreciate your participation today. We look forward to seeing you at our next event, and I hope everyone has a great day. Thank you so much for coming.